Hello, everyone. We're going to get started with the afternoon session. My name is Ingrid Werner, not Lukas Schmid. I'm a professor at The Ohio State University. And it's my great pleasure to be the chair of this session. We're going to talk about what type of corporate characteristics should active managers pay attention to, and how corporate characteristics and or corporate decisions are linked to expected returns. We have two excellent speakers. We're going to start by hearing from Lukas Schmid. Lukas is a professor of finance at Fuqua, Duke University, and he has worked extensively in the area between macroeconomics and finance. And I organized a conference last summer, and I had a very hard time picking which of his papers to put on the program. In fact, I had to exclude some. Sorry about that, Lukas. He's very prolific and a great researcher. Welcome.
All right. Thanks a lot for the kind words and for the invitation to be here. It's great to be here. So actually I got that invitation about a year ago. So and then I had to come up with a title for my talk, and I didn't know exactly what I would have to talk about in a year from now. So I came up with leverage-based asset pricing, and that was kind of natural. I had done some work on leverage and asset pricing before, so I felt that's something I should have something to say about. But yet it was unspecific enough so that I was moderately optimistic I could fill it with some content. So I think what I tried to fill it with over the year actually qualifies properly as leverage-based asset pricing. And I feel, and I leave that up to you to judge, that it still kind of fits the overall spirit of the conference, hopefully reasonably well. Okay, first of all, what can we think about when we hear the word leverage-based asset pricing? Basic idea is to make inference or to deduce, derive firm valuations, or more specifically, equity valuations from the debt side of a firm's balance sheet. So that could include information about the leverage ratio, the maturity structure of debt on a firm's balance sheet, the debt structure, whether a corporation mostly finances itself through corporate bonds or loans, what kind of loans, and then there could be pricing information, so corporate bond prices, loan prices for that matter, so kind of characteristics. We've been talking about characteristics a little bit of the firm's balance sheet. Now that's still very broad and very unspecific, so there's still a lot of content I could fill that with. So I've decided to kind of make an application of that leverage-based asset pricing idea to an asset class which we haven't talked much in this conference yet, but maybe we will. And basically it's about the application of leverage-based asset pricing to the valuation of private firms. And when I talk about private firms, I don't mean like the bakery around the corner. I mean private firms that are held as portfolio companies of large private equity investors. So what these private equity funds do, they buy up a lot of companies. They hold them for a long time. They kind of restructure them potentially. And then after 5 or 10 years, they try to exit them, to sell them again, which is when they make money. Now, that's an increasingly important asset class, perhaps not for me, but for large institutional investors. Like the company that manages the endowment of my employer, Dumac, has an asset allocation of about 25% to privates. So that's why we should kind of understand these private equity funds better, or we should be able to value them and think about performance measurement. Now, the problem from an asset pricing perspective of private firms is exactly that they're private. So we actually don't have a lot of real-time market valuations for private firms. In that time, when they're between they're bought and when they're exited, we basically don't see market valuations because they're not traded. They're private. We see cash flows. We see kind of asset valuations, but these are mostly self-reported. Now that's an issue because we can't, in Itai's world, we can't learn from public prices about these companies. And in Jules' words, we can't tell whether their performance is anomalous or not. That's an issue from a performance measurement standpoint. compensation is a big deal when it comes to private equity. Fees are high and fee structures are complex, so we should kind of be able to relate the performance fees funds to the fees among others. And we see kind of private equity fund managers that regularly appear among the wealthier people in the world, so we probably should have a sense of performance measurement here. So the basic starting point of my analysis here is that many of these private firms actually have a lot of leverage. So it takes a lot of money to buy and take one of these companies private. So typically the private equity funds get that funding from the debt side, so they're highly levered, especially the so-called leverage buyout funds, which is what I'm going to focus on here. So I thought, well, leverage buyout, leverage-based asset pricing. And that's basically inspired by the simple observation that while we don't have market valuations of the equity side of these firms, we actually surprisingly often have market valuations of the debt side. If a large public company is taken private by a PE fund, well, they had corporate bonds traded before. They will still have the corporate bonds traded when they're private. Then for a lot of other private companies, we actually have loans. We have some transaction data on loans, but we also actually have quotes, which is from dealers. We have dealer quotes about the loans in the secondary market. So that gives some sort of a market signal about how the market evaluates the values of some of the claims to these companies. So basically, one of the questions that we want to ask here in this context, and that's kind of how it relates to the morning part of the conference, is can we learn anything about the valuation of the equity side of these firms from prices that we actually get to observe, or at least quotes that we get to observe in debt markets. So we want to learn about that valuation, and the way we're going to try to learn about that valuation relates to the afternoon part of the conference. We want to use standard tools of modern empirical asset pricing to try to extract information about the value of equity from debt prices. So basically, we're going to estimate an asset pricing model from debt credit market factors and debt or credit market characteristics. So in some sense, what I'm going to try to do is estimate the empirical linear, not quite linear, factor model from debt market data. So in kind of theory lingo, what I'm going to try to kind of get at here is to estimate a stochastic discount factor, kind of a discounting tool, evaluation tool for equity from debt market data. So with that discount factor, we can do valuations. We observe cash flows. So we're going to try to see whether we can, what we're going to call the credit market valuation of private equity, if we can kind of make some progress on that one. So that is what we're going to label the CME, and you're going to see very soon why we want to call that the CME. So now I've narrowed down the content of my presentation just a little bit. Now I can actually give it a proper title. So I'm going to talk about credit market equivalence and the valuation of private firms. And well, the one in the middle is still me, but this is joint work with Nicholas Huther, who is at Indiana, and Roberto Asteri, who is at the University of Lausanne. They both have been visiting Duke for a long time, and that's actually where we started talking about these topics. And it was Nicholas, who is the PE guy in the team, who got us interested in the valuation of private firms. Now I thought valuation, valuation is easy. I learned how to do valuation. I kind of teach valuation, so that should be easy. Let's give it a shot. And so in some sense, I thought, how do I teach valuation to at least PhD students? I know there's going to be some sort of a payoff in the future. T plus J, maybe in 10 years when the exit event happens, for example. And we want to know what's the price of that payoff today. Now, well, it seems natural to start with assuming that the price has something to do with the payoff in the future. The issue is that most often I don't actually know what that payoff exactly is going to be, so I kind of want to make an estimate, an expectation about the payoff, but there has to be something that links that price on the left-hand side to the expected payoff on the right-hand side, and that's what we call in asset pricing. I'm not going to call that asset pricing theory. I'm going to call that asset pricing in theory. We're going to call that a stochastic discount factor, an SDF, and for whatever reason, people call that thing that links the expected payoff to the price today, the stochastic discount factor. So that's a valuation tool that helps us discount cash flows, and there's a kind of very simple underlying logic that's involved here in the sense that it tells us the value of a payoff in the future, in a particular state. So that could be in the distant future. And what that M does, it tells us that if times are good, so if you just got a bonus, then probably a dividend from your stock investment is not going to be that terribly valuable. And if you just got fired, that is not a forecast, then probably such a dividend payment may be very valuable. So that's when the discount factor is going to be high. So that's kind of looks like a bit like higher abstract nonsense, and a lot of asset pricing models actually basically boil down to a specification of an SDF. So under some assumptions that we like to make in theory, markets are complete and no arbitrage and things like that, such a thing actually exists and oftentimes is unique. Now, in some sense, most of the asset pricing models that we see and use again, boil down to a specification of an SDF, like CAPM, FAMA French, and I'm sure what Lou is going to talk about just as much. And if you have the thing, and a stochastic discount factor, well, we can do lots of funny things. So, for example, we can, if the payoff that we're looking at in a couple of years from now is a dividend plus the resale value, the price of the stock at that point, we can just divide that through. And we get a lovely expression, which is E equals EMR. And I always tell my students in my PhD class that asset pricing is really easy because you only need to know one equation, and it's 1 equals EMR. So that's what we often call the fundamental equation or fundamental theorem of asset pricing. And from a practical perspective, it basically helps us evaluating the performance of a portfolio, for example. So if all assets are consistently priced, then that equation should hold for any asset. If there are deviations, or if some asset violates that equation, then it's perhaps a good investment opportunity. So the deviation from that equation is exactly what we typically like to think of as an alpha. If that deviation is positive, the alpha is positive, then it's a good idea to invest. But the alpha might as well be negative. So once we have that, we can do a lot of interesting things here. So we can, for example, ask if we observe a bunch of returns on a bunch of asset classes, what stochastic discount factor makes this equation hold? So that's basically one of the exercises that I've done in empirical asset pricing. Try to come up with factors that describe a stochastic discount factor so that this equation holds for as many assets as possible. So to minimize mispricing. We can do the opposite too. We can start with a discount factor and ask what the right price of an asset has to be so that it satisfies this expression. That's basically valuation. So I thought, I kind of understand that at least reasonably well. So we're all set. Let's get at valuation using an SDF, of private equity companies using such a stochastic discount factor. So basically, if then at least there are lots of ifs here. If we observe returns, then we can figure out what stochastic discount factor makes that equation hold. In private equity, you actually do not observe lots of returns. There's a little bit of a secondary market in PE, but not a lot. So that seems to be a no-go. If you would try to do the reverse, so if we have a stochastic discount factor, we can check whether returns satisfy the equation. we can value companies. But then that raises the question, what should that stochastic discount factor, what should an M be for an investor in private equity? And that's not entirely obvious either. So all set was a little less obvious to me now. So, but it turns out, of course, that we were not the first to realize that this is not an easy problem. So researchers actually have proposed a number of stochastic discount factors, a number of M's to evaluate PE performance. So basically, the starting point here, the groundbreaking work was Kaplan and Shoar, who proposed a first stochastic discount factor for PE investments. So that's what it looks like. It basically depends on the stock market returns. That's not exactly the way they wrote it, but it's an equivalent way of stating what they've done. So basically they say, let's discount PE investments by the stock market return. Good times is when the return is high, bad times is when the return is low. And using that stochastic discount factor, I can basically value private companies. So that's what they call the public market equivalent, the PME. So that's a valuation tool that's still often prominently used in applications. There is a little bit of an issue here that unless you're willing to make very, very stringent assumptions about where that comes from, it implicitly assumes that the betas of lots of portfolio companies are basically 1. Now, that's an issue in the sense, or kind of is a little unsatisfactory in the sense that we know these companies are highly levered. So the average company in the S&P 500 has a leverage ratio about 3.3. These companies and funds often have leverage ratios 0.7, 0.8. So probably that's kind of missing out on some of these valuations. But what the question that basically that SDF answers is, would investing in PE improve an investor's risk-return trade-off for an investor who's fully invested in the public stock market? Now, we know that these betas are probably not just 1, and that most investors are not fully invested in the public stock market. So more recently, Korteweg and Nagel propose a generalized public market equivalent. And basically, the stochastic discount factor is of this form, which looks similar, but basically is a stochastic discount factor for an investor who is invested in a portfolio of the public stock market and a risk-free asset. So that valuation tool now allows for different betas for different investment opportunities, which makes sense, especially, or which is probably a good thing to have in the context of highly levered buyout companies. So the question again is, would investing in private equity improve the investor's risk-return relation on opportunity set? So that's basically what's done so far. It's widely applied and is certainly a good strategy. We propose to do something slightly different, and I'm coming back to this leverage-based asset pricing idea. So we're going to propose a leverage-based M. So we're basically going to propose to extract prices, data, information from prices on credit markets, instruments on private equity companies to construct such a stochastic discount factor, such a valuation discounting tool. Now that maybe sounds a little abstract, but what we're going to do basically in practice, we're going to replace the returns on the stock market portfolio, which was in the SDFs of Kaplan, Shoar, and Korteweg and Nagel, with the returns on a number of credit market instruments. A number J, so there's going to be a bunch of factors, and already now I can tell you that J is going to be 5, so it's going to be a 5-factor model. And why is that? Because every good asset pricing model these days has 5 factors, and I'm sure Lou is going to agree with me. So what are we going to do? So basically our stochastic discount factor is going to be of this form here. So basically the factors that go into this stochastic discount factor is not just the stock market, it's a set of returns on credit market instruments. And the question that this stochastic discount factor helps answering is how are private firms' equity consistently priced with their debt? Or in other words, can investing in PE improve the risk-return relation of an investor who is already invested in the private firms, but through their debt instruments? Now, of course, that kind of only makes sense if equity and debt markets are not completely separate. So if an equity investor actually can make investments in credit and vice versa. So in finance lingo, they're not entirely segmented. And I'm going to show you some evidence later on that this is not an unreasonable assumption in this context here. So that's what we want to do. How are we going to do it? Well, first of all, we need data. So the first thing we do, we create a novel, relatively large data set of loan and corporate bond returns for companies that are actually held by private equity funds. So for private companies. So that's this pricing information that is going to come from this data set. So this relies obviously on two sides of a data set. First, we get traded bond prices from Trace. That's available for every transaction since the early 2000s. And then we have data on loan pricing in secondary markets from LPC, the Loan Pricing Corporation. That's proprietary data, and that gives us a set of bond loan pricing information for a whole bunch of companies. Now, we need some PE data. Most of the PE data is for PE funds, so for the entire set of portfolios of private companies that the fund manages. But loan data is not for funds. Loan data is for companies, so we need data on portfolio companies of private equity funds. And we actually got that from a data source which I assure you exists, but must not be named. So it's one of the largest international investors in private equity, where we get kind of portfolio company level data and cash flows and characteristics. So we can match those portfolio company data on PE with the pricing information on bonds and loans that's available. So that gives us a matched data set, and from that data we want to extract information about pricing. So then now we're in standard asset pricing world. Typically we sort stocks into portfolios and look at the returns. Now we sort loans and bonds into portfolios and look at portfolio returns. And then we're going to ask what factors are going to help best explain the cross-section of these debt returns. Now, we needed to come up with a bunch of factors. Is FAMA French a good starting point? I don't know. CAPM, maybe not for loan returns. So we didn't know which ones to use, so we created the zoo. We entered the factor zoo of loan returns and used kind of a variable selection techniques to identify which actually have some explanatory power. So we use a lasso. Used to call that lasso, now it's called the machine learning. So what that gives us at the end of the day, we can also do rich, but it's still machine learning. So that gives us a standard asset pricing expression for this stochastic discount factor. It involves all these factors that we're going to construct, and once we have those factors, we can compute CME valuations for PE firms, from PE firms' cash flows. And the first thing we do is we want to compare them to the valuations that come out of the PME and the GPME. So that's what we're doing. I'm going to give you a quick overview of what we find, and then I'm going to give you some more details depending on how much time I have. So the first thing is that it's important to verify that there's some connections between debt valuations and equity performance. So otherwise, there is some lingering thought that maybe these markets are entirely separated. So first thing, we're going to show that there are significant connections between credit and private equity markets, in the sense that debt market characteristics and debt market valuations actually predict PE performance, and some of the valuations, the exit valuations that we actually observe. So then that gives us kind of the background to start our asset pricing investigation. So we're going to try to figure out what are the credit market instruments or the credit market characteristics that help us understand loan and debt return and bond returns. And what we're going to find, there's some credit market equivalents of some of the characteristics that we find predict returns in stock markets that predict returns in debt markets. So it's not going to be Fama French. Probably it's not going to be the Q factor model, I haven't tried. But it's momentum in loan markets. It's volatility, some sort of value factor in loan markets, and importantly, liquidity that seem to price the cross-section of PE debt market returns reasonably well. So I think that's a good starting point to build a stochastic discount factor. And with that stochastic discount factor at hand, we're going to do valuation. We're going to do simple valuation. So it turns out that in our sample, and there's some reason for that, that the GPME and the PME valuations don't paint a very nice picture of private equity performance. A lot of those funds or firms actually have negative alpha, so they underperform when you value them using GPME or PME. But our CME valuation, and we didn't have any kind of forecast of that, actually paints a more positive picture of PE performance in our sample. So we know that PMEs and GPMEs do paint a nicer picture in other samples. In our sample, it doesn't. There are some reasons for that. So there's underperformance under GPME and PME, but at least neutral or slightly positive performance under CME. So that suggests that kind of information from credit markets, especially significant exposure of buyout performance to credit market factors are unrelated to public stock market activity. Okay, so that's what we find. Let me talk a little more about the data. So we have the cash flow and valuation data from 121 PE funds with about 2,400 unique sample portfolio companies. So the vintage years start from 96 to 2013. So now one thing that's important to note is that some of these companies have realized returns, so they've been exited already. So once they're exited, we actually do see a price, basically the price at which the company is sold. But another, basically 50% in our sample are not exited, so the realized the returns are not yet realized. It turns out about 40% of the companies that were exited in our sample are realized below cost. So they're kind of, you sell them at the lower price than you bought them. So that's the PE data. Then we have the loan price data. 2,200 facility from 6,000 borrowers between 98 and 2018. That data set kind of features all kinds of data like bid and ask prices. Some of them are quotes, some of them are actual prices, the type of the facility, and so on and so forth. We merged that with deal scans to get more information about the loans and the debt. And then we add information about accounting data. Now, CompuStat doesn't help us here very much here, so we use what we can get from Orbis. We take those two data sets, we do a big merge. What's left is loan pricing data for about 80% of the funds. So 80% of those funds, that means about 96 funds, we actually have a significant loan pricing data that we can exploit. Now, of course, there's lots of caveats here. There's a lot of issues about selection. Which of these which companies' debt, which portfolio companies' debt, which funds' debt is actually traded in secondary markets? Are these just distressed debt and so on and so forth? There's lots of caveats here. What we see if we kind of compare the funds in our data set to kind of a benchmark, larger data set that's used otherwise, a prequin sample, our funds are slightly smaller. than those, but otherwise there are kind of no noticeable or kind of very strong differences. Okay, so I want to verify some of these connections between debt valuations and PE performance. So here, this is just a regression table. We estimate some linear probability models of exit equity performance. So the first thing here tells you basically that the probability that if your loans are distressed, that you're going to exit under cost or you're making losses is significantly positive. The exit valuations themselves are higher, the higher the log average bid prices on the loans. And the holding period return on the bonds is going to be on the debt is going to be significantly positively related to the loan returns, so to the exit returns. So in that sense, debt performance valuations in debt markets seem to co-move, at least in a reasonable, on a kind of intuitive way, with equity valuations whenever we see them. Then the next thing we do, we basically ask, how likely is the company going to exit? Is that related somehow to the loan market? So we estimate some hazard ratios here, and what this says here basically is that whenever you have a distressed loan, your loan is distressed, then you're going to try to exit quicker. Probably because they anticipate, they forecast that exit valuations will drop as well. On the other hand, you want to kind of wait longer. The likelihood that you're going to exit anytime soon, if the bid price is large, then it is going to be lower. So that basically means they probably forecast that prices, exit valuations are going to be rising. So that's a sign to hold on to the company, not just to get rid of it right away. So that's another kind of link between expected exit valuation likely and debt valuations that we see in our sample. Then the next thing is we want to see what happens to debt valuations when you take firms private, and what these kind of negative coefficients up here tell us that kind of bid prices, average bid prices on loans fall actually quite significantly once a company is taken private. Probably because these companies now, they're levered up, have much more leverage, and are probably much more likely to be distressed. So that kind of gives us some indication that there is indeed the linkages between debt valuations and private equity valuations, that it seems reasonable at least to try to extract some of that information from debt markets to value private equity investments more generally. So here we go. So how do we do that? So we need to understand what drives debt prices. So we need to understand what determines loan returns. But now again, we are in standard empirical asset pricing world. We have a cross-section of loan returns. We can do basically all these exercises that we typically do with stock returns, so we can sort returns and into portfolios sorted according to some sort of characteristics, and to see if there's any cross-sectional variation with respect to these characteristics in debt markets. Now we're going to do quintile portfolios. So that's an exploration, and in some sense we have to exploit those characteristics that we actually have. So what are the characteristics? So we look at spread to maturity. That's the loan spread relative to maturity. That's a measure of credit spread. We look at momentum. We can look at those loans that did well in the past and the past losers in the loan market. We can look at price, the current quoted price as a percentage of the par value of the loan. In a way, that's very relatively close to a market-to-book type of argument. It's a valuation ratio, which tells us how far the valuation is from what's originally promised. We can look at market capitalization, the current quote times the amount outstanding. We can compute measures of volatility. So these are kind of related to standard risk factors that we use in the equity market as well. Then there's a number of illiquidity or liquidity-related characteristics that we can use. We can use the number of quotes. We can look at bid-ask spreads, and then complementing our data set with data from Orbit, we can look at accruals and profitability. So we do all kinds of quintile portfolio sorts, and we look if we sort them according to these characteristics, where do we actually get a return spread? Now, I'm not going to show you all the 20 tables. So that's the summary of those 20 tables. We actually find significant return spreads around 1 to 2% annually. That's not like in the equity world, but it's still significant, associated especially with those characteristics. Now, if there's cross-sectional return variation in loan returns, we like to think that this cross-sectional return variation somehow reflects differential exposure to risk factors and their pricing. So we have to ask what factors, if any, explains these returns differential. Again, we are entering the factor zoo here. So we built high minus low sorted portfolios on some of these characteristics as candidate factors, like SMB is small minus big, so that's kind of very related here in spirit. And then we do the standard asset pricing exercise. We run time series regression of portfolios on candidate factors to get exposures, betas, and we check whether these average portfolio returns actually line up in the cross-section to get some risk price. And that's where our little machine learning exercises come in. What do we find? Well, we identify a number of 5 factors. That was not by design. That actually price the cross-section of loan returns reasonably well. What are these factors? Momentum, positive risk price, volatility. Then this is basically price. That's the high minus low price. Portfolio, that's price relative to current quote relative to par value. So that's the market to book portfolio. That's opposite of book to market. So book to market typically has a positive risk price. So that's the inverse. We get a negative risk price. That's MV here is market capitalization with a negative risk price. And BA is the bid-ask spread. So liquidity is priced positively in this setup. So the results from this second stage regression suggest the 5-factor model for debt returns, which is based on characteristics or portfolios that kind of are relatively similar or analogous of some of what we see in stock markets, like market to book, size, liquidity, and so on and so forth. So we would like to see that the returns on these loan portfolios that we build kind of line up with the predicted returns, and that's a standard picture that we like to draw. So this is average predicted returns against average realized cross-sectional returns, and in an ideal world, we would like to line them up on a 45-degree line. Pretty close to 45 degrees, and the cross-sectional alpha is small. So that 5-factor model kind of is a first step towards pricing loan returns with all the caveats that I've mentioned. But it does seem to price these quintile portfolios reasonably well. So now I've done loan returns. I started to talk on factors. I started the talk by talking about all these M's. So what's the M? Well, the M is exactly what I've argued earlier. It depends on these risk factors. And what are the risk factors? It's these high minus low portfolios, which have a significant risk price in the end. Now, we can use this SDF to price any cash flow. We want it to price the PE cash flows, and we think that makes some sense. There's a good starting point because, as our earlier analysis showed, that debt and equity markets here are not entirely segmented. So what do we find? Well, we do valuations and kind of here under CME, under GPME, under PME for all deals that we have data for, and for realized deals that we have data for. Now, again, the picture here for GPME and PME is mostly negative, sometimes significant. So from a PME perspective, these valuations often come with underperformance. Now, that's perhaps not super surprising because a lot of these companies actually are distressed, and therefore that's probably what this reflects. The CME paints a little brighter picture in the sense that in all deals, that means those that involve self-reported end valuations here, we find overperformance, although noisy, but we find no significant underperformance here for the realized deal. So the performance looks somewhat brighter in the light of the credit market performance through the lens of the CME, so that underperformance for me really may reflect credit market exposure that's missed in the PME valuations. So that's the current analysis that we have, and I'm going to conclude by recalling those two questions that I've asked earlier on at the very beginning. Can we learn about the valuation of private equity from prices in debt markets? And can we use in a reasonable way that credit market CME valuation to value private firms? So in some sense, again, the first question relates to the earlier part of the program. The second question relates to, I'm sure, what Louis is going to talk about. And I think the question is a preliminary yes. I think debt price data can help us understand what's happening in private equity because it helps predict PE performance, so that's a linkage. And I think the second question is also a slightly more qualified yes, in the sense that accounting for credit market exposure helps understanding PE valuations in our sample. Thank you. Is that for me? Chocolate.
Do you want to stay up for a second? Are there any questions? We have a couple of minutes. We started late, so I will see if there are any questions. Otherwise, we can catch up at the very end too, before the break. Yeah, yes. Please, Jules.
So it's interesting. You said they should not entirely be segmented, right? But I think the statement is they should entirely not be segmented, right? Another way of saying it, if you want to back out an SDF, you can essentially use any asset class, regular equities, regular debt, and anything that you want to try to construct that SDF. And so as long as anything is not segmented with anything else, you should probably use the largest cross-section of assets that you can use to construct the SDF.
So
the question is, the other approach would be to say there's an emergent pricing model. We know what the pricing of the food option is, which is essentially what the debt instrument is, and then that I back out what the coal price needs to be, which is the equity equivalent. Right? And that's another approach of specifically using these asset prices to say something about the coal price and the underlying asset value.
So I agree with you with your point. I think when it comes to what I said, they shouldn't be entirely segmented. I think I would expect them in the real world to be somewhat segmented. Ideally, of course, it would be completely integrated. I don't expect that to hold true. That's why I'm saying if we see no interaction between the pricing, they're probably too segmented for this to make sense. If it's a little segmented, I think it might be still a reasonable starting point.
What if they're more segmented, but more connected to regular equity markets?
That's a good question. In some sense, that's what we tried, right? And so we threw in a whole bunch of factors that people have used. So that takes account of that to some extent, in the sense that most of these, like equity factors, maybe as a particular, we didn't try the VIX. They just don't do anything. So in that sense, these seem to be the factors that give us the most cross-sectional explanatory power. I think that takes care of that to some extent. But you're absolutely right. That's what one should expect. It's not what we see.
I wonder whether it is a legitimate robustness check if you use the same technology to apply for public firms, which issues both equity as well as debt market instrument. How is your methodology applied?
So that's a good question. We could check that. That's right. We haven't checked that in particular, but well, you could see in some sense maybe that those secondary market investors in the debt market actually are not investing in the public equity market. But we don't know. We should check. That's a good point.
Great. I'm going to leave it at that. Thank you so much, Lukas. Lukas, you have a gift here. You're leaving me.
Wow. I thought that little chocolate was it. But
no, you get something else. Thank you so much.